Boom! What is up, Waves Capital? It's Royce Jacob. Welcome back to the channel and welcome to another edition of Trader Tips. In this quick video, we are going to be discussing why the stock market and the economy are two completely separate things and why this concept is especially important to understand now, given the fact that our macroeconomic climate is looking a bit bleak. Okay, so we do have a few things that I've prepped that I want to read over with you guys just to kind of talk about why this is the case and why specifically the stock market is a leading indicator of the economy. Okay, at least many believe that to be the case, myself included. Okay, so we'll go over all of our necessary reading today, and then at the end of the video, I want to talk to you guys about how I see the S&P 500 or SPY playing out in terms of price action over the coming month or so, just because this does reflect some of the more optimistic sentiments that I want to display and convey in this video. Okay, so if you guys happen to be watching this at a later date, you can just skip this, but that's why we're going to save it for the end. And hopefully this is helpful to you in the case that you're watching this in a more timely fashion, because ultimately the S&P 500 is a direct reflection of the overall US equity markets. Okay, so that is the video, you guys. Before we get to reading, please give the video a like if you go on to gain value from it today, and a subscription if you're not already subscribed is very appreciated. Also, please let me know in the comments down below, what do you think about the nature of the markets right now? Are you bullish? Are you bearish? Do you agree with the sentiment that the stock market is a leading indicator for the economy? And if there's something that you think I missed in this video, please share with your fellow viewers down below. Okay, so let's get into it. Moving up here, this first piece is just a short excerpt from a newsletter that I sent out a few trading sessions ago to, of course, the newsletter fan. We're in a very strange time where bad news for the economy is good news for the markets. The reason for this being that a slowing economy where value and demand is being destroyed is an economy that the Fed wants. If the Fed sees that times are tough, then they believe they're doing their job at fighting inflation and are less likely to aggressively raise interest rates. The economy and the stock market are two very different things. The stock market is a leading indicator for the economy. This is how it's always been, and this is how it will continue to be. The markets are more efficient than ever, but they're also more liquid than ever, which is a major contributor to the volatility. So I do actually have a bit more that I want to read with you guys, but I'll save this for the end as well. Okay, so stock market, leading indicator for the economy. This is not an objective truth, I'll say that. Okay, I believe this to be a truth, but this is not believed by 100% of analysts or investors. Okay, so let's break down what a leading indicator is. What is a leading indicator? Okay, good old Investopedia. A leading indicator is any measurable or observable variable of interest that predicts a change or movement in another data series, process, trend, or other phenomenon of interest before it occurs. Leading economic indicators are used to forecast changes before the rest of the economy begins to move in a particular direction and make market observers and policymakers predict significant changes in the economy. Leading indicators can be useful to help forecast timing, magnitude, and duration of future economic and business conditions. A leading indicator may be contrasted with a lagging indicator. So obviously, lagging indicator is at the other end of the spectrum, opposite end of the spectrum of a leading indicator. I believe the case is that the stock market is a leading indicator for the economy, and of course, vice versa, the economy is a lagging indicator of the stock market. So what the stock market does is price in economic forecasting, and that's why a lot of times the stock market will see a recession. The stock market sees a recession well before the economy does, because a lot of times the stock market investors are able to price in economic headwinds before they actually happen. Okay, so there are a few other reasons. I want to reference this very old article, but I thought some of these underlying principles were timeless, which is why I'm choosing to cover it. So this is the article itself. This is just the publication itself, I guess, all the way from 1996. I mean, I was a young one when this was released, so this is almost as old as I am. But again, in investing, in psychology, in just the nature of the markets, a lot of the underlying fundamental principles stay constant, okay? It doesn't matter what the environment is. It doesn't matter how much tech has evolved, because obviously the world is a completely different place than it was back in 1996. But when it comes to the nature of the markets and the behavior of markets, most of the underlying principles just stand the test of time. Okay, so we're not going to read all of this. I only have 3 paragraphs that I want to share, but you guys can go look into this if you want. These are the ones that I felt are most important. I'll expand on these, and then once again, we'll just close it out by talking about price action for the S&P 500. The question of whether the stock market can predict the economy has been widely debated. Those who support the market's predictive ability argue that the stock market is forward-looking, and current prices reflect the future earnings potential or profitability of corporations. Since stock prices reflect expectations about profitability, and profitability is directly linked to economic activity, fluctuations in stock prices are thought to lead the direction of the economy. If the economy is expected to enter into a recession, for example, the stock market will anticipate this by bidding down the prices of stocks. Okay, so big relevant thing going on right now, right? All of the headlines you read at this point in time. Market will see new lows, right? Recession imminent. There's so much talk of this inevitable recession that the stock market has not yet priced in, which I do argue to be the case, unless we get a black swan event, of course, where there's something completely unforeseeable that happens. But personally, just to give you guys my thoughts on the market environment right now, and once again, I'm an optimist. I do have an optimistic take relative to, again, the 99% of investors who are feeling bearish. I would say I do have a contrarian take because I do not think the bull market is back in full force, and I don't think new all-time highs are coming, but I do think that there's further relief to be had, and again, the majority of downside is likely priced in the case, once again, that a black swan doesn't fly into the picture. The wealth effect is also regarded as support for the stock market's predictive ability. Pierce, 1983, again, Timeless Principles, argues that since fluctuations in stock prices have a direct effect on aggregate spending, the economy can be predicted from the stock market. When the stock market is rising, investors are more wealthy and spend more. As a result, the economy expands. On the other hand, if stock prices are declining, investors are less wealthy and spend less. This results in slower economic growth. Okay? And this is kind of what the Fed is seeking to do right now. In the process of raising interest rates, they're trying to destroy demand. Okay? Big reason the stock market's been correcting growth stocks specifically is because everything got, everything got overinflated during the media of the pandemic, of the Fed injecting liquidity into the system and literally stimulating the stock market, right? A perfect example for the wealth effect, that is a bit of an extreme example, but it provides it provides an easy picture for you to imagine, is like crypto bros, right? There's a whole bunch of kids and adults out there who got into crypto early, got super rich, super fast. They were spending the load on probably some pretty vain items like Lamborghini Uruses, right? One of the hottest like Civics in LA for a period of time, right? Not anymore. That has changed, but that's an easy example of the wealth effect. When the markets are up, when investors who are typically on the wealthier side and definitely the bigger spenders than kind of the lower class, when they make money and they feel rich, they're going to spend more, which ultimately stimulates the economy. Okay, so that's kind of that trickle down effect when the markets are doing really well. But when they're losing money, I'm sure a lot of us can unfortunately attest to this over the past 6 to 8 months. When investors lose money, you become a bit more frugal. You start looking at the restaurant bill a little bit more, and you are going to slow down your spending, which ultimately just slows down the pace of the overall economy when that just given the multitude, the scale at which investors slow their spending. Okay, so critics, however, we'll fight back a little bit on this. Critics, however, point to a number of reasons not to trust the stock market as an indicator of future economic activity. Pierce argues that the stock market has previously generated false signals about the economy and therefore should not be relied on as an economic indicator. The 1987 stock market crash is one example in which stocks prices falsely predicted the direction of the economy, instead of entering into a recession, which many were expecting. The economy continued to grow until early 1990s. Okay, so this is a very interesting indicator. okay? And it will be interesting to see how this plays out this time around. Because, of course, with the Fed jumping in and wanting a recession, and many believing that a soft landing, the soft landing everyone's talking about, isn't possible, it will be interesting to see if maybe the economy does come back. Maybe a soft landing is possible. But the inflationary data, the August CPI data at the time of recording, the previous month of recording, is coming out soon. That will be a big indicator. Okay, so before we dive into the charts, before we dive into S&P, I do want to read over this second part, or just the lower section of, I believe this is my trade. It's probably my Trade Alert newsletter. Yeah, Trade Alert newsletter from September 5th. I just saw it. So again, you guys, if you're watching this at a later date, I appreciate you watching. You can probably tune out now. But if not, this is kind of my take on the market. This market environment is a different kind of slippery, and I can't recall, I can't say that I recall experiencing a dynamic like this in my near decade of trading. Guess this makes sense considering our current macroeconomic environment is in uncharted territory, but specifically the lack of rationale when it comes to our successful earnings plays immediately crumble is difficult to understand and even more difficult to justify. So if you guys have been part of the portfolio group, you know that we have been nailing it on earnings. Like every earnings play we've had has literally, I think the stock has jumped at least 10% every earnings play we've played so far over the past couple of weeks. But unfortunately, the fear is returning. Everyone's getting scared again, and these haven't delivered as they initially. Profits were taken, of course. That's just the nature of how I trade personally. But I mean, it's weird how this has been unfolding. So this is only to you guys if you're part of the portfolio. There's a lot going on in this world, and it's understandable that investors are feeling fearful. I know I may sound more foolish by the day as the downside persists, but I still believe further upside is ahead for some of our larger holdings. We've known that volatility was to be expected to kick off the new month, and it's more likely than not that this volatility continues over the coming sessions, considering this is a compressed trading week. The August CPI data is released on September 13th, and you already know I believe that will act as a positive catalyst for the markets, which is why on the SPY chart, I have September 15th marked, okay? And mid-September is a very important time for the markets because the August CPI data is released. The Fed meeting is in the days following the CPI data, where they talk about how hawkish or dovish they are, pretty much whether they're gonna press on the gas and raise interest rates a lot, or whether the August CPI data shows inflation cooling and they might slow down a little bit and give the economy some time to breathe. So hold your ground, as we always say. If you have a game plan, stick to it and don't let the fear cloud your judgment. Another day of downside, another opportunity to capitalize, another principle as old as time. If you have fundamental conviction in something, 3-day weekend is needed. Let's reset and refresh. Stormy seas create for skilled sailors. Okay, so before we dive in to the S&P on the charts, talk about overall market direction. If you guys want to know how I personally trade my portfolio on a day-to-day basis, every single call option, put option, stock position, cryptocurrency position, updated on a daily basis, then check out the first link in the description box down below. That will take you to this page, and you can check out my complete portfolio and daily newsletter. If you sign up for this with any of the following pricing plans, completely up to you. Always unsubscribe. Trust will stick around. But you get everything that this little write-up right here states. And once again, it's just how I trade on a daily basis. And the newsletters don't only give you my take on the macro, but also include charts, daily price targets on some of the larger holdings, on some of the positions that I'm the most excited about at that point in time. And of course, rationalize the trades I make. So again, if you want to join, welcome to the winning team in advance. I'll see you in there. Again, first link down below. Appreciate if you check it out. If not, no worries at all. Let's dive into the charts, okay? So the S&P 500 on the day of recording has officially broken the line of support. So I want to make this very clear right off the bat. This is an objective red flag. From a technical perspective, it would be foolish not to believe that this is a red flag. But we have seen what is it like out of the past 12 sessions, I think I just thought about this earlier. Out of the past 12 sessions, we've only seen 3 green days, and barely green at that, okay? So, been a lot of red. It would make sense that a bounce is due. There's a lot of oversold looking metrics right here. Daily stochastic RSI pretty much basing out on the bottom. More likely than not, the more longer you just travel on the bottom like this, just slugging on the bottom, the more likely a bounce becomes. And also, just traditional RSI is well below its exponential moving average, and it's also near a historical level that acts as support for RSI. Like RSI, let's move my fat head real quick. RSI currently sitting at about a 34. A 30 is very low for RSI. So I do think that maybe we come down a bit more. That's possible, but again, the SPY from a daily candle perspective is looking oversold, and of course daily candles because I want this to be a more medium-term analysis. All right. So on top of that, the SPY is currently printing somewhat of a symmetrical pattern, pennant formation, but it kind of looks like a beak. I'm going to call this the beak pattern, all right? The reason for that being there is an obvious line of resistance for the S&P 500, all-time high, January of this year. Next touch point right here. Next touch point we saw in early August when everything was looking like it was coming back. I still think that this was not just a bear market rally. I do think that further relief is ahead, but this did prove that at least that crazy kind of manic price action that we did see for a few weeks there following those June, July lows was a little overhyped and got overextended, okay? It also speaks to how relevant our good old stick figure trend lines are and how even at the grandest scale, the S&P 500 ETF trust, the SPY is arguably the most like liquid asset in the US financial markets, and this followed, look at that, like boom, trend line, tested it to an exact T. Again, today did break below it, closed just on top of it, so we did not close a daily candle, which would have been a lot more bearish. We are still within this formation. Okay, so cut to the chase, 9:15. Again, 13th, August CPI data is released, I think 16th or 17th, correct me on this if I'm wrong. The Fed meets and talks about what they're doing about interest rates and what they're thinking about the future months, of course. Personally, I think that will act as a positive catalyst for the markets. Other than that, Q2 earnings, 75% of Q2 earnings exceeded analyst expectations. That's good. Things aren't as bleak, and there is talk of a potential soft landing. That's of course not guaranteed, but there are many trains of thought that lead that makes sense for a soft landing to be the case. But realistically, it all comes down to inflation and whether or not inflation is cooling down or not. Okay, so my belief is that inflation does cool. I think the Fed will come out a lot less offensive and a lot less doom and gloomy than they did at Jackson Hole, and I do think that will provide relief to the markets. I think it's possible that by the beginning of October that we do come test this little line of resistance for the SPY on its uptrend, and also test one more time the line of resistance on the overall downtrend. Again, these two kind of intersect September 30th. Going into the month of October. That would take us to about 420. Maybe come back up here, test this one more time off of positive fundamentals. Again, the Fed meeting, creating that upside catalyst. Come back down, get into this resolution area of this little beak pattern. And I do think that by mid to late October, I have 1021 here because that is a significant options contract expiry date. So there is going to be exceptional volatility around here. It's likely that around this time we do see a resolution either to the upside or downside. This over here is when I'll get a little bit more bearish just because I think Q3 earnings are going to be looking pretty ugly. But hey, who knows? Things could change, and that's why I'll do my best to keep you guys posted. Okay, so appreciate you guys watching. Lastly, I do have a little content recommendation for you guys. I did send this out to the newsletter. I believe in this email, but this AMA with Raoul was kind of the inspiration for this video, and maybe just think a little bit more about it and want to share my thoughts on the subject with you guys. But this is just a Q&A with Raoul, who I view to be one of the most significant mentors in my life personally, in my journey trading and investing. Taught me a lot about just kind of how to think, and in my opinion, this dude is one of the best macro analysts on the planet. So what he has to say in here it has fallen in line with a lot of my beliefs over the past few months, the current state of the macroeconomic backdrop. And again, if you're optimistic, I recommend you go watch this video. Okay, so we'll call it there, you guys. Once again, I'll see you in the comments down below. And if you want to join the winning team, if you want to step up your trading investing game, I'll see you in here as well. Okay, until next time, always remember, take action, make waves. Peace.